All right. Welcome back, everybody. This is an important lecture. It looks like we have everybody here. Is Kristen here? Kristen's not here, is she? Well, hopefully she'll come in late. Okay. Important lecture. I want to get right to it. First thing I want to do is I want to go through the homework that was assigned for today. And I don't want to spend a lot of time on that because I want to get to some new lecture. And I don't want to have to end early or anything. So let's go ahead and hop over to Quick Study 6.5. Quick Study 6.5. And let's take a look at that. This has to do with the very first part of the Chapter 6 lecture that we did previous period. Homestead Crafts, a distributor of handmade gifts, operates out of owner Emma Flynn's house. At the end of the current period, Emma reports that she has 800 units or products in her basement, 10 of which were damaged by water and cannot be sold. She also has another 400 units in her van, ready to deliver per a customer order, terms FOB destination, and another 100 units out on consignment to a friend who owns a retail store. How many units should Emma include in her company's period end inventory? Okay. All right. Anybody get the answer?
Yeah.
What'd you get? 1190. Close.
Well,
1290.
Anybody get a different answer?
because 400 units.
Well, we'll go through it. We'll go through it. Don't you worry. Anybody else? No? 1290. Good job. All right. Let's go. Let's see how we got that. Okay? All right. Well, first of all, she has 800 units in her basement, correct? Okay. Now, 10 of those are damaged, so we need to subtract those out. Okay? She also has 400 units in transit. Now, they said that those were FOB destination, right? So those are, who's paying for the transportation at that time? Emma Flynn, the seller, right? So she owns and includes those goods in her inventory.
She's still in control of those goods.
Yes, but the specific question is who's paying for that transportation when they're on the road? Since she is, she owns them. Okay? Now, we also have to take into account the units on consignment, which are 100. There's 100 units of the on consignment. Emma Flynn is the consignor. The retail store is the consignee. The consignor owns this product. And so the total units in ending inventory would be 1290.
Okay. Then I have a misunderstanding on consignment because I think that once you hand over a product to a retail store, that is their product to sell. They are responsible for selling it. They pay you for it up front. And then they...
I can understand what you're saying, but you're misunderstanding what consignment is. What consignment is Emma Flynn has given products to her friends to sell at her retail store. The person at the retail store hasn't paid Emma Flynn for them. She hasn't purchased them from Emma Flynn. What she basically is saying is, yeah, I'll try to sell them for you. And you know what? If she doesn't sell one of them, guess who gets them all back? Emma Flynn. Okay? Emma Flynn. So she hasn't purchased this from Emma Flynn. In a way, it's like this. Let's say my buddy Brett's having a garage sale, and I see him sitting across the street having a garage sale on a Saturday morning. And I say, hey, Brett, can you do me a favor? I don't have time to sit here. I don't have time to have my garage sale, but I have a lawnmower I'm trying to sell. Can I just put a price tag on it and push it out there and put it in your garage sale for the day? And he's like, sure. Sure, that sounds good. And if it sells, I'll give you the money. And I said, and if it sells and you give me the money, I'll buy you a beer later on today. Whatever. Okay, that's your incentive, I guess, to sell my lawnmower. I come home at the end of the day. Let's say you're still sitting over there. You sold a lot of your stuff at the garage sale. My lawnmower didn't sell. Whose is it? He's going to go, I didn't sell it for you. And I go, okay, and I'll push it back to my yard. Consignment's kind of like that. And in that example, I'm the consignor, you're the consignee.
Okay.
So even though you have possession of it, you never paid me for it, you're just trying to sell it.
So then if someone were to actually pay for it, that would be a purchaser, seller, whatever situation.
Well, yeah, if they pay for it, if they purchase it, yeah, then it's theirs. Then it's theirs.
But it wouldn't be considered a consignor
No,
or...
that's not a consignment situation.
Okay.
So what if it's like in a store and you said like the incentive to sell the lawnmower was to buy them a beer? What if they wanted like half of the profit if they were going to
Well, they
sell
might.
in a store?
You can arrange whatever profit that you want.
So
But
like
again, in a
value.
consignment situation, if they don't sell any of the product, you give it all back. The
If they-
person never owns it. They're saying you can put your product, you still own it, you can put it in my store and try to sell it. Okay.
But if they do sell it, does that like make the value less of your inventory or what you receive back? Like
Well,
if
then you have to
counting
get
it?
into the situation of accounting for the sale price and the cost of goods sold and all that sort of stuff. Okay.
What's the catch on that kind of thing? Like eBay stores and stuff like that? Like, you're putting your stuff in their store to sell, and then if they sell it, they keep part of the profit, or what is that?
It's
I don't
not much
understand.
different than the garage store example. If you sell it, I'll give you something for your efforts. Okay?
Okay, cool.
Yeah. So, or you could, if you want to monetize it, you could say, try to sell my lawnmower for $50. If you can sell for $50, then I'll give you 10. I'll give you $10. Okay.
How would the revenue from that be like recognized as the seller, so the consignee?
How would the revenue be
Would
recognized?
it just go straight into revenue because they didn't really invest any money in the
Well,
profit?
no. Originally, I had purchased the lawnmower in that example.
I meant for the person selling it.
Oh, for the person selling it, like if I gave him $10, he'd
Yeah.
just count as $10 of consignment revenue or whatever. So,
Okay.
but there's lots of times we have revenue that there was no good that we actually ever owned, right? If I'm an attorney, I have revenue all the time, so that would almost be more of a service situation. Okay. All right. Okay, quick study 6.6. Jabbar Company has shipped 600 of goods to Chi Company, and Chi has arranged to sell the goods for Jabbar. Okay? Identify the consignor and the consignee. Okay? First of all, who's the consignor? Who's the consignor? Jabbar or Chi? It's Jabbar. Okay? The consignee is Chi. Okay? Jabbar is the consignor. The consignee is Chi. Okay? Which company should include any unsold goods as part of its inventory? Well, the consignor, Jabbar Company, they're the ones that should include any unsold and consigned goods in its inventory. Okay? Since they are the consignor. At year end, okay, any questions on that one? Quick study 662. At year end, Lou Company had shipped 750 merchandise FOB destination to Quan Company. Which company should include the 750 of merchandise in transit as part of its year end inventory? It is Lou Company, right? Why?
Destination.
Free on board destination. That means Lou is paying the transportation costs
So it's delivered.
until it's delivered. So while it's on the road, again, who's paying the transportation? Lou is. They include it. Okay? Great. All right, one more. River Associates, antique dealers, purchased the contents of an estate for $75,000. Terms of the purchase were FOB shipping point, and the cost of transporting goods to Rivers Associates warehouse were $1,800. Rivers Associates insured the shipment at a cost of $300. Prior to putting the goods up for sale, they cleaned and refurbished them at a cost of $1,750. Determine the cost of the inventory acquired from the estate. Okay? All right, what'd you get? Anything?
I got 77,100, but I was kind of confused on and unclear on the refurbished part.
Excuse me. Okay, here's the cost. It's $78,850. Did anybody get that? Okay. You have the price of that inventory, but you also have to include the transportation in, which is the shipping charges, the insurance, and the cleaning and furbishing. Really, it's any costs, normal and expected costs, to get that inventory up and ready to sell. Okay? So the cost of the inventory on your books would be $78,850. All right?
I was unclear because on the little slide that says determine inventory costs, it says include all expenditures necessary to bring an item to sellable condition. So that's why I was thinking that you would include refurbishing. But when it goes into like the little bubbles down below, it doesn't say anything about like anything doing that.
Well, yeah, and that can't be an exhaustive list on that slide you're saying. Basically, though, you just include all costs necessary to obtain the inventory and to get it to sellable condition. So they can't give you a master list of every scenario that could ever happen with any piece of inventory. Okay? So just ask yourself, is this a necessary cost to obtain the inventory and get it ready? Okay? But in Quick Study 6-7, that would be a total cost of $78,850. Okay? All right, questions there? All right. We are going to shift gears now. Okay? We're going to shift gears, and I want to have you engage your brain. Okay? Like I said, the challenge of this chapter, teaching in this format, is that I only have what I don't have that I use in the classroom is a big wide whiteboards on both walls that I can show everything as I'm doing it. Okay? And I don't have that in this classroom. Everybody's looking pretty much at the same screen. You folks here are watching it here live. You folks at home are watching it on your computer monitor or whatever. Okay? So it's kind of like being a math teacher, and my chalkboard and my whiteboard is only, that big. It's a bit of a challenge, isn't it? Okay. Anybody taking a math class? And they use all the whiteboards, right? Okay. So we'll work within those constraints, and I'll talk to you throughout this chapter how we're going to do it, because this chapter has a lot of numerical detail. Okay. But we'll get through it. But please recognize that I'm aware that we don't have big whiteboards to use, but we'll get through it. We'll get through it. Okay? All right. Let's look at a situation here. Let's look at a situation here. Situation 1. Chalmers, a merchandiser, sold 3 jump drives. You know what a jump drive is? It's those little memory sticks that you guys use. They sold 3 jump drives to a customer at a sales price of $22 each. Chalmers had purchased the units of product at a cost of $12 each. The journal entries for Chalmers would be. Okay. Now this might be a good little quiz to see if you can make those. As a matter of fact, just go ahead and take 30 seconds. I don't think you need to roll the music or anything. We're just going to take 30 seconds or so. And just see if you can scratch down those journal entries real quick. There's going to be 2 of them, right? You folks at home can get a little piece of scratch paper and see if you can make those as well. All right. We're using a perpetual inventory system here too, as we will in all of our examples. All right, let's take a look. Okay, well, and let's assume we sold them on credit. So what we do is we debit accounts receivable and credit sales for how much? 66. Okay. because we sold 3 of them at a sales price of 22, right? Okay, now we also have to record the cost of goods sold, and we have to decrease the merchandise inventory, correct? And what will that amount be? 36. It's 3 times the cost of 12, right? So that's our answers right there. 2 journal entries, right? Okay? Hopefully not too hard. That should be review at this point, right? Okay, now I want to look at a little different scenario. I want to look at a little different scenario. Now here what we had is we had a sales price of $22 each. And we also had the cost of the product was $12 each, correct? Now let's change the scenario a little bit. Situation 2. Chalmers Inc., a merchandiser, sold 3 jump drives to a customer at a sales price of $22 each. Now here's where it changes. Chalmers had purchased the units of product at various per unit costs of $11, $12, and $13 over the last year. Now, this is the typical situation, right? How many times have you purchased gas over the last year? Quite a few times, right? Was it the same cost per gallon every time you purchased it? Absolutely not, right? So in this situation, they're selling these jump drives, and they've bought them from manufacturers, but the price has gone up and down depending on what the economic conditions were, right? So the costs were either 11 or 12 or 13 depending on the time. So let's make our journal entry here. We're going to record the sale, debit accounts receivable, and credit sales for, what's the amount? 66, right? All right. But now and then we know we're going to have to, in our second entry, we have to debit cost of goods sold, and we have to credit merchandise inventory. Right? But the question is, it's not as clear cut, is it? It's not the same. The costs are different. We can't just say 3 times 12 because we have purchased these items, and this is even a simple example too. You could have a situation where there were, dozens and dozens of different costs per unit, and they're all just stored there, right? Okay. Well, what are the various ways that we could account for this?
But that would be wasted. You could just add them.
Okay, what I think you're getting to when you guys say add them up, I think what you're going to is that we could figure some sort of average out, right?
Well, are those the 3 that they sold? Those 3 in particular? Or is that just how a bunch of different ones cost over the year?
Picture this. Picture just a huge bin full of jump drives. They're all identical. Some of them were purchased at $11 per unit. Some of them were purchased at $12 per unit. Some of them were purchased at $13 per unit from our manufacturer. A customer comes and takes 3 of them, and we sell them to them for $22 each. Mm-hmm. But we don't know. We just know that this big bin of jump drives has been purchased at a lot of different costs.
Oh, I have no idea.
Okay. Well, let me guide you thinking. But you can see where it's a different situation, right?
Yeah.
Yes.
How the stock market is. When you buy stock...
No, I'm not going to let you go there, okay? I want to keep my example simple, okay? Let me ask you to hold off your questions for now, because I don't want you to take us down different roads, stock market and stuff. Don't want to go down there, okay? I want you to focus on these jump drives. But do you see how this situation is different when there's different costs involved? Is that fair enough to say? We can all agree on that? Okay. What you could do is you could figure out some sort of average, and in this chapter we're gonna talk about that. The other thing that you could assume is you could say, well, let's just assume they were the earliest purchase of jump drives. And the earliest purchase was $11. They've been gradually increasing in price over time. So we'll just assume that they were the $11 ones. Or you could say this. Well, let's just assume they were the latest purchases, the most recent ones. So they're the $13 ones. Okay? Well, that's another way that you could do it. Okay? But the important point is that looking back at this little slide here, it's not clear cut what number you put into that journal entry unless and until you make some sort of assumption in regards to how your inventory costs flow. You with me? There's a number of different ways that you can do that. We're going to learn about 4 of them in this chapter. Okay? I want to talk about 2 of those methods right now. Okay? 2 of those methods right now. I want to talk about, and maybe you have heard of these before, okay? I want to talk about what is known as the FIFO method, and I also want to talk about what is known as the LIFO method of cost assumption as far as how the costs move through our system. Okay? Does anybody know what those stand for? First in, first out. Last in, first out, right? Very good. Okay? Hold on, look at my notes here for a second. All right. I want to expand on a little bit, but yes, this means first in, first out. Okay? What do we mean by out? I mean out the door with the customer. So in this situation, in FIFO, we would assume that the first ones we purchased, those are the ones that are sold. That's the cost that was sold. Okay? In a LIFO situation, we assume last in, first out. Last in, first out. In other words, the most recent costs, those are the ones that we assume go out the door with the customer. Okay? Now, I like to expand these, and this is not in your book, so you might want to write this down. I actually like to think of it as FIFO, LISH, LIFO, FISH. What do I mean by that? Well, I will tell you. It sounds like a Dr. Seuss book, doesn't it? Okay. FIFO LISH stands for first in, first out, out the door with the customer, but the last in is still here in inventory. Okay? First in, first out, last in, still here. So, the inventory items are the jump drives that we bought earliest. Those are the costs that we assume went out the door with the customer. The latest ones, the last in, are still here in our ending inventory. Because sometimes I'm going to be asking about what's the cost of goods sold, and sometimes I'm going to be asking about what is the value of the inventory that we still have. Okay? When you talk about, we talked about FIFO LISH, what about LIFO FISH? Well, you can probably figure that out. The last in is the first out the door with the customer. So those costs that were the most recent are the way we assume our costs move. And the first ones, the first costs, first in, still here in our ending inventory. Are you with me? These are the 2 methods we're going to talk about today. FIFO and LIFO. Now, I usually will just say FIFO and LIFO. But I want you to know that really, I kind of like to think of it like this. And sometimes that might help you as you're doing it as well. Are you with me? Okay. Questions? Okay. Here's where we get into my snazzy animation. Okay? Now, I've taught this many times, and as elementary as this seems to help students learn this concept. I will also say this about these concepts that we're going to learn today. Some students pick this up immediately. It's just like second nature to them. Other students, it takes them, they have to think through it a little bit. It takes them a little longer, okay? All right? So if you're picking it up right away, awesome. But I want to get as many people on the bus as we can, okay? So bear with me if you think we're going too slow. Okay, let's say that we have, let me set up my little deal here, okay? Let's say we have a warehouse here, and that's my warehouse. Let's say we only purchase and sell one type of item, okay? And so in my warehouse, I store these items. You can just kind of think of these maybe as crates or whatever, and each of these crates is an item that we sell, okay? You with me? Yeah. Okay. Now let's say that we purchased from our, and we're the merchandiser, we're the retailer. From our manufacturer, we purchase 3 of these items, and they cost $10 each. So I stack them right there in my warehouse, okay? I have a feeling I'm going to need to make my warehouse a little taller. Okay? So we have those 3 items right there, okay? Now what is the value at this point of my inventory? $30. 3 times 10, correct? Okay. So some time goes by, and I purchase 5 more from my manufacturer of the exact same type of item. Okay? So I'm going to stack those in my warehouse. Okay, right there. Same items, I'm just writing the cost that we paid for illustration purposes on the item itself. So what is the value of my inventory at this point, total? 90. We have the 3 times the 10 equals 30, 5 times the 12, which equals the 60, total of $90 worth of inventory. You with me? Okay. Some time goes by. We purchase a couple more of these items. The price has gone up to $13 each. Okay? So, what is the cost of my inventory now? 116. 30 plus 60 equals 90 plus 26. Correct? Okay. Now, let's say that we have a customer who comes. Boy, look at this animation. You're going to love this, okay? The customer comes, here he comes, and he wants to purchase, he's going to purchase 4 items from us. So in other words, we're going to make a sale of 4 units. Are you with me? You with me? Now let's say first of all that we are going to use the FIFO method. Okay? Let me write this down. Let's say we're going to use the FIFO method. Okay? Well, he purchases, or we make a sale of 4 units. Under the first in, first out method, which are the 4 units we are going to assume that we sold cost-wise? Exactly. This one, this one, this one, and then we have to dip into that layer. Because those were the first that came in for us, right? Is that correct? So the customer goes out the door. First of all, what's the cost of the goods sold? 10, 10, 10, and 12. 42, right? Now, I said first in, first out the door with the customer, right? Now, once he's gone, last in is still here. Our latest ones are still here in the inventory, correct? So, what is the value of our inventory at that point? Okay, let's see, 48 plus 26, 48, 58, 68, 78, 74. Okay? So, make note of that. Our inventory is $74, and our cost of goods sold was 42. Okay? Everybody understand that? That's the FIFO method. Okay, let's go back to our original situation. Okay? Our original situation. Okay. These were the items that we had purchased. A little time went by, then we purchased these items. A little more time went by, then we purchased those items. Okay? Now what we're going to do is LIFO method. Okay? So here comes our customer, and we are going to use the LIFO method, and we make sales of 4 units. Under the LIFO method, which one are we going to assume that we sell? The last in is the first out. Okay? Then we have to dip into this layer. The last in is the first out with the customer. Okay? So he goes out the door. Before he leaves, what was the cost of goods sold? $50. That's different than what it was before, right? So he leaves. And now what is the value of our ending inventory? $66, right? Last in, first out the door with the customer. First in, those earliest ones still here. Are you with me? Make sense? Now, any questions on that? Now, we're just going to use the first 2 methods. And I'm going to guess on some of the questions that you're going to ask because I've taught this enough. But go ahead. You're not going to talk about Wall Street, are you?
No.
Okay, good. What's your question?
They keep track of somewhere as to how many you bought at each price, right?
Yes.
Okay.
Yes. It's in the system. And all this stuff is easier because it's tagged and those sort of things. Okay? You know, with the
So
like
it's not like
barcodes and stuff.
It's you know how much you paid for each item then. Well,
Yeah, it's all in your costs, okay? All right. Now what I want to show you is how we are going to look at these via an inventory sheet. Now you have a handout, you folks at home and you folks here, that have a bunch of inventory sheets in the back. Okay? Now let's go through these. And I want to show you something real quick, okay? And hopefully you'll be able to see it. All right. Okay. In this situation, we have our purchases column. We have our cost of goods sold column. And then we have our inventory balance column. Okay? Now, the first units, I'm going to go back to that example. On the first date, we bought we bought 3 units at $10 each for a total of $30. Is that correct? Yep. And so what is our inventory balance at that point? 3 at 10, $30, correct? Now let's purchase the next layer. Now we purchased 5 more at 12. So what is our inventory balance now? Well, we still have 3 at 10 for 30, but then we just purchased 5 at 12 for 60, okay? I'm writing it a little bigger so you can see it, because I know it's enough of a challenge. Are you with me? Then we purchased some more, didn't we? We purchased 2 more at 13, right? On whatever date. I'm not putting the dates. So what is our inventory balance now? Well, we still have the 3 at 10 for 30. We have the 5 at 12 for 60. But we also now have the 2 at 13 for what? 26. Are you with me? Now, when you use these inventory sheets, notice that I'm leaving some blank space in between these transaction dates. Do not shove it all up there together, or it's going to be very hard for you to see the different dates. Does that make sense? You're always going to have room. So don't start at immediately the next line, or you're going to get into a big mess. Okay? Okay, now we sold 4 of these units, and let's say we sold these at a unit price, at a sales price, per se, of 20 bucks. Okay, well, this is cost of goods sold. This is cost of goods sold. So, under the FIFO method, and I always say up here, write what you're doing here, so when you go back to study it, you'll remember it. But under the FIFO method, the cost of goods sold, when we sell 4 units, we will say the cost of the goods that were sold. Well, we sold 3 of the cost of $10 ones, right? And then we had to dip into that other layer. So we sold 1 of the $12 ones. So my cost of goods sold there is $42. What do we have left in our inventory? Well, we sold that layer of $10 ones. We sold 1 of those $12 ones, but now we have 4 of the $12 ones left. And we have both of the $13 ones left, don't we? Okay? So our ending balance in inventory is 74. This is under the FIFO method. Now nowhere on this chart does the sales price, what we sold to customer, nowhere does it come into play, because we are talking about the cost of the goods sold. Okay? That is how we write this out on those inventory sheets. Now we only have about 10, 12 minutes left, but I want to make sure we get through an example that you work on in class and that I can go over. So what I want you to do is look in your handout and do the SpongeBob Incorporated example. SpongeBob Incorporated. Now you should all have this at home. Should be in your blue book. Everybody here has it. There are inventory sheets in the back, or you can fold it out so that you can see both of them. But go ahead and do SpongeBob Incorporated. Let's go ahead and roll the music, okay? Okay, you may not be quite done, but if you at home are watching this, then just pause it, finish up, and push play when you're done. But I want to make sure I get through these answers. Okay, first of all, here are the numbers that go in your blanks, right there for SpongeBob. Okay. Now, how many got those? Raise your hand if you got those. Anybody here? Okay. How in the heck did we get those numbers? Well, let me show you. Okay. What we did is okay, we started off on April 1st. We purchased 5 at 8 for 40. So that's what we purchased, and that's also our beginning inventory. This is our inventory balance. Then the next day came, or the next time came, we purchased 9 more at 9 for 81. So what's our inventory balance now? Well, we have those 5 at 8 that are worth 40, and we have the 9 at 9 that are worth 81. That equals 121 in our balance. Then April 17th comes. We purchase 6 more at 10.50. We have 63. So what's in our inventory balance now? Well, we have the first layer, 5 at 8 for 40. The second layer, 9 at 9 for 81. And the last layer, 6 at 10.50 for 63. For total inventory, actually I didn't total it up that time. 184. Is it 184? Yeah. That equals 184. Thank you. Now we make a sale, correct? We sell 12 units at a selling price of $29 each. Now, the biggest mistake that students make is they have $29 written right here. But this is the cost of goods sold, isn't it? Nowhere on here does the sales price show up. We could have sold these for $1 million each and it wouldn't have showed up here at all. So since we are using the FIFO method as designated up here in red, we say that we sold that earliest layer, 5, and then we had to dip 7 into this layer, correct? So our cost of goods sold is thus 5 of the 8 at 40, 7 of the 9 at 63. Cost of goods sold equals 103. What do we have left in our inventory? Well, we entirely sold that layer off. Of this layer that we had previously, how many do we have? We had 9. We sold 10. Now we have 2 of the $9 cost ones. We had 9. We sold 7. Thank you. And now we have 2 of the $9 ones. And this $6 layer, we have the whole layer yet, don't we? So that in yellow is how I got the answers for the FIFO method. Now, I believe you folks at home, because of the difficulty in seeing detail, you actually have the answers in your blue book. Let me tell you, though, guys, for you folks at home, don't just look at the answers. Just use it to check your work. You're not going to learn this just by looking over it. You got to do it yourself. Let's look real quick at the answer to LIFO. Okay? Let's look real quick at the answers to LIFO. It's done the same way. As a matter of fact, all this information right here highlighted, that all stays exactly the same. The only difference under LIFO is when we make a sale down here. We sell 12 items. Now we say, last in, first out the door with the customer. So we presume we sell those 6 at $10.50. And then we have to dip into this layer. We have to dip into 6 of those 9, don't we? So what do we have left in our inventory balance? We have that entire first layer, earliest layer of $8 items, and we have 3 of the $9 ones. Thus, our ending inventory is 67. Our cost of goods sold is 117. Okay? Make sense? These take practice. Do not think, though, that you can just watch me do it or look at the answers and figure it out, okay? What I want you to do for homework, and I know we went through a lot today, I want you to do, in your handout, I want you to do, and I'll show it up here on the screen, I want you to do BB's boating example. Do all of this. BB's boating example. Do not do ABC weighted average. Don't even try it. Don't do this. But for new technique, I want you to work on that one, but I just want you to do FIFO and LIFO. Don't do the weighted average, okay? So BB's boating, do the whole thing, and then do FIFO and LIFO for new technique company. Does that make sense? Okay, we'll see you guys. Bye-bye.